Good afternoon, everyone. Let's wait for the slides. My name is James Cook, and I'm one of the portfolio managers on JPMorgan Global Growth and Income Investment Trust, which from here on I'll refer to as JGGI. It's our ticker and a little easier on the tongue. So before I start, I want to give you a brief introduction to our strategy and the three key things you need to consider before thinking about investing with us. So the first is that JGGI is a global, unconstrained, best ideas strategy. We have access to JPMorgan's full research capabilities, where we cover around 2,500 companies. And within that, we're looking to hold the best 50 or so ideas. That means we can go anywhere in the world to find our favorite companies, and we make no compromises when it comes to our stock selection. Second, our objective is to deliver capital returns in excess of the market, while also offering an attractive dividend yield with a 4% payout policy. And that payout policy meant that during COVID, when many companies were unable to pay their dividends, we could carry on paying our shareholders through previously built up capital reserves to ensure a vital income stream during those difficult times. And I believe it's that balance between growth and income that makes JGGI so attractive to our shareholders. And then finally, this is an award-winning investment trust. We've won awards for best-in-class returns over 2021 and 2022 from the likes of Citywire and Investment Weekly. We have a 5-star rating from Morningstar, and all of that has helped us to grow the size of the trust to around £1.8 billion. We're one of the few investment trusts to be trading at a premium. And since managing this strategy, our team has delivered returns 27% above the benchmark. Now, what I argue is more impressive about this number is that over the last 4 years, we've gone through two major style regimes. We went through a growth regime from 2019 to the end of 2021, and then a value regime over 2022. And over both time periods, we managed to deliver strong excess returns, illustrating that our stock selection is independent of the style regimes that we're in. I think that makes us uniquely attractive to clients. So with that said, over today's presentation, I'll take you through three key areas. The first is why I think investors should be excited by the global stock market. The second, why JGGI is such an attractive proposition to those investors who want access to the best companies in the world. How we go from our 2,500 companies that we research down to the best 50 or so ideas. The key criteria that we're looking for before we make an investment. And then finally, our market outlook and where we're finding the most attractive opportunities today. So I'll start with global equities. And if I think about our UK investors, 10 years ago, had our UK investors been domestically focused, had they put, say, £100 into the FTSE 100, that £100 would be worth roughly £180 today, illustrated by the yellow line. Relatively reasonable set of returns. However, had they considered investing in the global stock market, had they considered investing that £100 into, say, MSCI World, which is a broad-based equity index, that £100 would be worth roughly £330 today. That's nearly double the return of the UK stock market. So for those investors willing to look overseas, we think there's a vast number of attractive opportunities out there for you. And again, this time, if we just look at the best performing stocks over the last decade, rather than the entire market, what you can see from the pie chart behind me is that the best performing companies don't come from any single region, but instead they're scattered across the world. So to find them, you'll need a global lens. In fact, of the top 50 performing companies, about half of them came from the United States, the other half from Europe and developed Asia. It's worth noting that not one came from the UK market. So while the US is renowned for having some of the best software, internet, media companies, names like Microsoft that we hold within JGGI, which is fast becoming a market leader in cloud computing, an area that we see as high growth for many years to come, or MasterCard, as we go from a cash society to a cashless society, we see reasonable levels of growth with strong economics. However, not all the best companies in the world come from the United States. Some of the best industrials come from Japan, names like Keyence, which is a market leader in automation sensors used in a wide variety of industries, from food production to car manufacturing, used to improve productivity and quality controls, both of which are increasingly important in a world of higher wage inflation. Or in Europe, you'll find names like ASML listed in the Netherlands, which has a monopoly and leading-edge technology in shrinking the size of semiconductor chips. So for all your new iPhones, AI, data centers, all of that requires smaller, more powerful computing. And all of that is reliant on the technology owned and sold by ASML. So that's why we think investors should be excited by the global stock market. I'll now take you through our proposition. What we're trying to achieve, what's our objective. So JGGI is a global, unconstrained, best ideas strategy. And at the portfolio level, we have two main characteristics. The first, or two main objectives. The first objective is to deliver key characteristics better than the benchmark. We want to have superior quality of earnings. We want our companies to have high barriers to entry, high barriers to profitability, so that they are not at the mercy of their competitors. We want them to have strong balance sheets and resilient earnings, so that they are not at the mercy of the economic cycle. And we want them to have high returns on invested capital, so that the cash that they generate can be redeployed into attractive fields. And from the blue bar behind me, you can see we believe about 70% of our portfolio is in high-quality businesses, as deemed by our research analysts. That's 20 to 25% more than the index. It's one of the highest levels we've been running at since managing this strategy. And if we go through an economic cycle, we think that'll bode well. Second, we want to grow faster than the market. We want our stocks to be exposed to areas of high growth for years to come. We want to get insight into that growth. We want to be able to model that growth. And we want to get conviction into how long that growth can last. So again, by the green bar, you can see we believe our portfolio can grow 3% a year faster than the benchmark can. And then finally, we want all of that, and we want it at a better price than the market. We want our stocks to be spitting out more cash than the market does. And again, by the purple bar, you can see we believe our portfolio has a 6% free cash flow yield versus the index at 5.5%. That means we're spitting out 10% more cash than the market does. So that's our first objective. Our second objective is to deliver returns that are independent of the style regime that we're in. So over the last 4 years, we've seen substantial macro volatility, and it's played out in the equity market. It's caused significant swings in style factors. It's ended up burning many investors who've either been exposed to the wrong style or have poorly timed their styles. So from 2019 to the end of 2021, we saw growth stocks, that's your software, media, internet companies, had outperformed the value stocks by about 60%. Your value stocks being your banks, your utilities, your commodities. It was one of the strongest growth rallies on record. We believed growth had become overvalued on our metrics. And yet, JGGI managed to deliver nearly 13% excess returns. Then in 2022, when we saw signs of overheating, when growth stocks could no longer deliver the same level of growth, interest rates picked up, and the value stocks began to perform. Value outperformed growth by as much as 30% over that period. And yet again, JGGI managed to deliver strong excess returns of nearly 10%. Illustrating, we believe that our stock selection is independent of the style regimes that we're in, and we believe that makes us uniquely attractive to clients. So that's our two objectives. But delivering on those two objectives is no easy feat. It requires significant resources and a vast number of opportunities, which is one of the main advantages of investing with JPMorgan Asset Management. It's our breadth and depth of research. So I'll now take you through our investment platform. I'll start with the breadth of research. So at JPMorgan, we have about 80 research analysts worldwide in the US, Europe, Japan, and the emerging markets. Each analyst covers an industry within a region. So we have a European banks analyst, a Japanese autos analyst, and if I need to speak to someone on Chinese property, we have a Chinese property analyst too. Each analyst covers around 30 stocks. So that gets us to our aggregate coverage of around 2,500 companies. I believe our coverage, our breadth of research is unrivaled. We make more than 5,000 company interactions a year. And JPMorgan spends about $150 million on our fundamental research platform. But it's not just the breadth, it's also the depth of research. So at JPMorgan, we're looking to hire career analysts. That means analysts that want to spend their entire careers just researching companies. The average analyst at JPMorgan has 19 years of experience. Take Rob Haim, for example. He's our European insurance analyst. He has about 35 years of experience. He was there for the tech bubble, for the global financial crisis, for the European sovereign crisis, and COVID. His insights were invaluable in helping us to navigate those markets. And that's just our fundamental research platform. We also have a quantitative research platform that helps us to better understand where our forecasts may be too high and where they may be too low. We also have a sustainable investing team that helps our research analysts understand the key ESG opportunities and risks with regards to the stocks that we cover. And then finally, we have a technology department that puts all of that information, all of that research onto one software, one platform, so that it's easily and readily accessible to portfolio managers like myself. So that's our platform. That's our 2,500 stocks that we cover. I'll now take you through how we go from the 2,500 companies down to the best 50 or so ideas. And for JGGI, we have a simple 3 key criteria checklist. For a stock to make the portfolio, it must adhere to all 3 of these criteria. First is that we want to see significant valuation upside potential in the stock. So at the heart of our philosophy, we believe that the long-term value of a stock is driven by its earnings power and the quality of its cash flows. So once an analyst has forecast the long-term earnings power of our companies, once they've valued the quality of those cash flows, we get an expected return. We then rank our stocks, our entire coverage, from the most attractive expected returns, the highest expected returns, to the lowest. And we're looking to buy the companies with the highest expected returns. However, we know that undervalued businesses can remain undervalued for prolonged periods. And therefore, we also want to have clear insight into what will make those companies perform. What is our edge? Where do we differ from the market? And then finally, we want these stocks to be high conviction. We want them to be the master of their fate. We want them to be quality companies with high barriers to entry, high barriers to profitability, so the master of their fate is not their competitors. We want them to have strong balance sheets and resilient earnings, so that the master of their fate is not the economic cycle. And finally, we want them to have a quality management team that will execute the investment plan on behalf of shareholders. And then finally, we don't ask our stocks to outperform the index, but instead, we ask whether they can enhance the portfolio. I believe that's a much higher hurdle rate. Less than 3% of the stocks that we cover, of the stocks that we look at, make the final portfolio. So that's how our stock selection process works. I'll now take you through 2 examples, and we'll start with Amazon. So as most of you are aware, Amazon is the world's largest e-commerce platform. It's one of the largest holdings within JGGI. And over 2022, Amazon had significantly underperformed the global benchmark. It had overinvested in capacity in its warehousing, distribution, logistics centers. They had more than doubled the capacity in the US alone since 2019. E-commerce demand was unable to keep up with that level of supply. And as a result, margins came down, earnings came down, and you can see that by 2022, on the left-hand side, Amazon effectively had no earnings. However, we believe that to be a short-term issue. Long-term, we think the earnings power of Amazon is intact. So valuations became attractive. That was our first criteria checked. What was our insight? Well, we believe that the structural demand of e-commerce will begin to fill the capacity that Amazon has built. And the capacity that Amazon has built will better facilitate next-day delivery. And from history, we know that that brings better pricing and better volumes, both of which will improve the margins and we believe will cause a re-rating in the company. Finally, is this a high-conviction stock? Yes, we believe it is. We believe it is the master of its fate. It's the world's largest e-commerce platform. There's high barriers to entry, and there's even higher barriers to profitability. In addition, we think that there's a quality management team here. They're acutely aware of where the margins have gone and the plan that they have in place to get margins back to where they were pre-COVID, already showing that they're prepared to right-size the business to do so. So I'll now take you through Marriott. It's a slightly different investment case. It's more focused around the reopening opportunity. So Marriott is one of the world's largest hotel brands. We bought this stock back in early 2022 after it had underperformed the broad-based global equity index. So since COVID, with the lockdowns, with travel restrictions, with consumers unable to go on holiday, unable to spend on travel and leisure, we saw the earnings of Marriott go below trend for several years. And you can see that on the left-hand side over 2020 and 2021. So therefore, valuations became attractive. That was our first criteria. What was our insight? Well, since COVID, With the consumer unable to spend on travel, leisure, and experiences, they've been overspending on physical goods. New laptops, new monitors, keyboards, furniture, DIY. But we don't think the consumer is going to need another sofa for the next 5 to 10 years, or another laptop for the next 5 to 10 years. We think that budget is likely to go away from physical goods and come back to experiences, to travel and leisure. That'll end up benefiting the likes of Marriott. Finally, is this a high conviction portfolio, high conviction stock? Yes, we believe so. This is a high quality asset. It's asset light, which means that as it grows, it doesn't need to deploy capital, and therefore it has the ability to grow and offer a dividend or a buyback, which makes it extra attractive to shareholders. So that's how our stock selection process works. I'll now take you through the portfolio. So here we have our top 10 holdings. And there's 3 key points here. The first is that this is a high conviction, highly concentrated portfolio. We make no compromises when it comes to our stock selection. The top 10 names make up about 40% of JGGI. Second, we're playing into a broad number of attractive themes. Whether it's Amazon with the margin recovery in e-commerce that we've discussed, whether it's Marriott with the reopening opportunity as consumers spend less on physical goods and move that budget back to experiences, whether it's Microsoft, which is fast becoming a market leader in cloud computing, an area that we see as high growth for many years to come, or whether it's NXP Semiconductors. This is a semiconductor manufacturer, either making chips, and as you go from a combustion engine vehicle to an electric vehicle with safety features, with more infotainment, i.e. you're getting maps, services within the car, you're getting higher semi-content. In fact, we think some of the latest cars are coming out with 3-fold more semi-content than the combustion engine vehicle. NXP plays into that growth. And then finally, this is a high-quality portfolio. We believe these stocks are the master of their fate. They are market leaders in the industries that they operate within. And therefore, if we go through a world of potentially higher inflation, we think they can price accordingly for that. So finally, I'll take you through our market outlook. And I'll break it down into 2 key areas: valuations and earnings outlook. I'll start with valuation. So behind me, the blue line shows you the forward consensus price to earnings ratio. The dotted green line, which doesn't look dotted on this one, the green line is the 20-year average, and the purple line is the 5-year average. So you can see that we're currently trading somewhere between the 20-year average and the 5-year average. So we don't believe that valuations are either particularly compelling, nor are they particularly demanding. However, where we do have concern is with consensus earnings outlook. So from 2011 to 2019, pre-COVID, we saw global profit margins at around 11.5%. They were consistent at 11.5%. They fluctuated no more than 1% either side of that number. COVID hit. We saw record levels of demand through the stimuluses. We saw supply constraints, and profit margins jumped to peak levels of 15%. Consensus believes those profit margins are here to stay, and we think that's unlikely. We think it's more likely that as demand normalizes and as supply normalizes, those profit margins are more likely to come back to pre-COVID levels than they are to stay elevated. And we've already began to see so. Over the last 2 quarters, profit margins have declined by about 1% each quarter. However, that's the broad economy. That's the broad stock market. That's not every stock. Where we're most concerned is on physical goods. And where we're least concerned is on services. And therefore, we have tilted our portfolio away from the physical goods and into services. And for that reason, we believe it's important that investors remain selective when they're investing. So with that said, I'll finish off with performance. And I'm proud to say that whether you're looking at our NAV performance or our share price performance, we've delivered strong excess returns over the entire time periods that I'm showing behind you. And I'll highlight two key numbers. The first is our 10 years performance, where we've delivered 1.9% annualized return in a growing market, and the importance of compounding. That means JGGI, in aggregate, has returned 220%, versus the index at 170%. These are significant differences in returns. And the second number I want to highlight is our 3-year number. It's a highly competitive 5.2% annualized return. Again, this team, since managing this strategy, has delivered aggregate 27% returns more than the benchmark. So with that said, I'll leave you with the JGGI cheat sheet. This is all the key information you need to know. If you're looking for a global unconstrained best ideas strategy, if you want your returns to be independent of the style regimes that we're in, and you want a healthy balance between growth and income with a 4% dividend yield, JGGI is an attractive proposition for you. So with that said, I'm done. If you have any questions, I'll be at the JPMorgan booth for the next 30 or so minutes. Please do come around and ask me questions. Otherwise, thank you very much for listening, everyone, and please do enjoy the rest of your weekend. Thank you.